US markets bounced back in overnight trading as investor confidence seemed to return and investment took a tilt back towards growth and away from defensive assets. This meant the S&P 500 was up around 0.75%, the Nasdaq up 1%, and the experience in the US was in direct contrast to what we saw here in the Asia Pacific region yesterday. The Australian market trading higher initially before falling into negative territory, and real pressure in Hong Kong with the Hang Seng down 1.8% in trading yesterday. So it's very clear that we're seeing different impacts around the globe as sentiment shifts, and that there is some switching, some international investment that's going between centres, and in particular between North America and the Asia Pacific region. So something to watch out for. Sometimes when they're up, we'll be down and vice versa, in contrast to the previous couple of years where we've all moved in lockstep. The big bounce back in US stocks was driven largely by those tech stocks that have been hit so hard recently. There's concerns about the impact of artificial intelligence on business models was played out in the market. So some massive moves in individual stocks. And remember, these stocks have market caps in the tens of billions, sometimes hundreds of billions of dollars, and they're moving around like in unbelievable ways. So Intel up 6.5% overnight. Advanced Micro Devices up 8.8% in a single session. And we've seen a similar impact in tech stocks here in Australia. Yesterday, Megaport was down 7.3%. And these huge moves in individual stocks can't be ignored by investors nor traders. The volatility we're seeing in individual names at the moment is historic. Today, we've got CPI in Australia. That could be a game changer. At this stage, it's expected that we'll see a fall in both the trimmed mean and the weighted mean of about 0.1%. That will bring them down respectively to 3.3 and 3.7%. Still well above the target range of 2 to 3%, and no cause for celebration amongst Australian mortgage holders. A surprise here, though, could be market moving. If the inflation reads today are well below market expectations, we could see a buying surge in the Australian share market as concerns about rising interest rates are alleviated. On the other hand, if the readings on inflation today come in higher than expected, the potential for an interest rate hike as early as the 17th of March at the next RBA meeting will become part of market thinking, and that could see selling hit the Australian share market. So one to watch out for late market on the East Coast today. We also saw US consumer confidence last night. It showed a surprise rise up above 91 now, moving back towards the neutral or positive territory above 100. We also have a State of the Union speech from the US president due during our trading session today. And given the potential for surprises to come from the White House, and in particular, any news around Iran or conflict being flagged in the Middle East could also be market moving. So something to watch out for, might come from nowhere. We've seen plenty of results still. The results season here in the Australia and in the US rolling on. Tonight in the US, we've got Circle and Lowe's. Today in Australia, we've just heard Woolies' result, and I haven't had a chance to look through it. It's breaking as I come out, but a 16% surge in first half profit at the headline level looks very impressive. I look forward to going into Woolworths numbers further, but as I say, at first blush, it looks like Woolworths have delivered a strong result. And then after market trading today, we'll hear from, it's not Whitehaven, it's WiseTech. And those codes are very close. And WiseTech, of course, having been in the headlines for all the wrong reasons last year, will return to a more business-like approach, one would hope, with the announcement of its earnings result today. Now, it's not surprising in a world where the rules-based order of trade has been pushed back and where conflict is rising all around the globe, that the defence sectors in various countries have been red hot. Spending is escalating. There's no two ways about that. We're now entering the 5th year of the war in Ukraine, and EU defence spending continues to rise. In 2025, it was just under 400 billion euro. It's expected to go up by another 2% this year. Go up to 2.1% of GDP. Further rises in Europe. In Australia, we're looking at the same sort of situation. In the US, In 2026, they'll spend $1 trillion on defense. And the president has already flagged that in 2027, that will rise to $1.5 trillion. And so the demand for defense-based goods and services continues to rise in every sector of the world. And it's a modernisation story. And it's a global story. We're talking about drones or the use of artificial intelligence, software that's driven and made more efficient by AI and used in all sorts of new systems, including missile systems. We're seeing a new and modern approach to warfare. And that means different companies have got different commercial opportunities as the world arms. Now, in Australia, ASB, the Austal, has been affected by an accounting error. Its share price has been under considerable pressure. But given its very strong pipeline of building, there is a case to re-examine it, particularly at these reduced share price levels. EOS, the drone guidance system company, has rallied 8% since its results on Monday, and it does look like it might have found some stabilisation. But I'd like to point out that the volatility in this sector is extreme. Both Austal and EOS have historic volatilities above 100%. Now, for a trader, volatility is good news. A volatile market is a moving market, and that's an opportunity. And of course, if one aggressively controls risk, it can be a terrific source of profit. However, it can make investors nervous. Volatility is the single most used measure of risk in markets, and higher volatility stocks do represent higher risk for investors. However, those who see these stocks at the lower end of recent trading ranges and looking at the potential for increases in spending around the globe might find that it's at a share price level where, despite the volatility, investors are prepared to look at the risks in the defense sector. It's a similar situation in the US, except that it has been less affected by individual stock news. So Northrop Grumman is up by 28% this year, and we're seeing stocks like GE Aero up 12%, Lockheed Martin up 37%, and a lot of the smaller stocks have had even bigger percentage gains as the defence industry grows and matures with that modernisation theme. So plenty of focus there. And so number one stock on our watch list today is DroneShield. Now, those who've been following this story might realise that that's higher volatility has been realised in DroneShield as well. In just the last 6 months, this stock traded up to $6.85 before plummeting below $1 and now rallying back to be around the $3 mark. Now, it's delivered its result. Its revenue is up 276%. And there's a whole lot of other good numbers coming out of DroneShield, but it's not the story. The story here is that DroneShield has gone from being a speculative technology company in the defense sector to a viable business. And the $214 million in EBITDA that the company earned last year speaks directly to that transformation of DroneShield from an experimental group to a cash flow business. And that in itself might attract a different class of investors to DroneShield. Its pipeline is huge, 2.3 billion pipeline, and it's working hard on increasing production capacity. It is a drone tech market leader. A number of analysts have a strong buy on DroneShield, and targets for this stock, remembering it's trading around $3 at the moment, up between $4 and $5.30. So one worth a look for those investors considering the defense thematic. Turning to US stocks, Workday, the HR software group, reported aftermarket in the US. So in other words, just an hour or so ago, Workday in aftermarket trading is now down 9%. And the slowing subscription growth suggests that this company may be transforming from a scalable tech startup to a more mature workplace-based business. And although the quarterly profit was up 54%, the guidance for the full year was only a gain in revenue of 13%. In other words, reflecting that maturation of their underlying revenue stream. The shares are, however, down 40% year to date. Clearly, some investors are concerned about the potential for artificial intelligence to cut across Workday's business. Workday itself says that AI is actually a boost for them, And a number of analysts have responded to that call from management with buy ratings. Clearly, whether investors are impressed by Workday or not will depend on how they see AI affecting its business, but one worth examination given that fall in the share price. And then finally, turning to advanced micro devices, it was up 8.8% overnight after announcing a chip deal with Meta. Beg your pardon. It's going to sell $60 billion worth of chips to Meta to back up its AI capabilities. It does validate AMD as a key player in this space. They've got a spend of US 155 billion this year, mainly on AI capability and chip-related building. There's also talk that AMD will soon be able to sell into China, although that does require government approval given the sensitivity of chips in this space. A number of analysts have a strong buy on AMD in the Moomoo community, and a target, taking an average of the target, and it is a wide range of target prices, but the average is around $281 a share, which would be more than 30% higher than the current price for AMD.